So, how do you start a hedge fund? Have you ever looked at institutional hedge funds and thought, I analyze markets just as well as they do? I invest like they do. Why am I just managing my own portfolio? Why don't I do what they do and get paid what they get paid? Most regular investors assume that starting a fund requires some type of Ivy League pedigree or a multi-million dollar Wall Street backing. But the truth, with modern regulatory frameworks, it means that independent operators can spin up alternative asset management businesses like hedge funds from scratch. So today we'll break down the exact blueprint, starting with separately managed accounts or SMAs as your proving ground, and then navigating the complex legal plumbing of a real private fund and why you have to satisfy two completely different sets of federal securities rules simultaneously. So if you don't have a proven track record, before you pull your money into a traditional hedge fund, the most common way and smartest way for a regular investor to manage outside capital and develop a record of profitable trading that they can use to market their hedge fund is through a separately managed account, an SMA. So what's an SMA? So instead of investors sending money to a single centralized fund vehicle like a hedge fund or private equity fund, the client opens up their own brokerage account in their own name and then gives the advisor limited trading authority via power of attorney, and they execute the strategy for that individual account. And why do that do that way? So there's zero entity overhead, right? You don't need to draft complex partnership agreements with general partners and limited partners or set up a multi-tiered fund structure like a master feeder fund right out of the gate. It lets you hit the ground running. It also ensures that it also ensures asset custody safety. So the client's fund are held at an independent prime broker or a custodian like Interactive Brokers or Charles Schwab. And the advisor can trade the money, but they can't touch or hold the cash. It's in your name. It also allows the advisor to track record building. So it allows them to build a verified, institutional grade, live track record with other people's money that they can use to pitch high network investors on a blind pool once they're successful at this. So if they have enough SMAs and they do well at it, they can start a fund and get those investors to invest in the fund. And with that record, get other people that hadn't been invested in SMAs to invest in the fund. So once you have that track record and you want to move past SMAs into a true pooled fund, you're going to hit a confusing part of the asset management puzzle. So you have to comply with two, sometimes three entirely different federal statutes at the same time. Why two or three? Because the government targets different risks, protecting investors from fraudulent marketing and protecting the financial system from fund mismanagement. So the first one we'll talk about is how you raise money versus how you operate the fund, right? So if you operate the fund as a hedge fund, you'd have to comply with 3C1 and 3C7 of the Investment Company Act of 1940, and that's overseen by the Securities Exchange Commission in their investment management division. So there are two different kinds of funds. 3C1 allows you to have up to 100 people, investors in your fund, and it lets you take standard accredited investors and a limited amount of unaccredited investors. 3C7 lets you take a lot more investors, but all of them have to be a qualified purchaser, which is a higher standard. So that's how you operate the fund. Now, if you are investing in commodities like futures, you would also have to comply with Part 4 of the Commodity Futures Trading Commission rules. And I worked for 2 decades at the CFTC, overseeing hedge funds and family offices. And those rules are very complex as well. But that's once the fund is operating, that's how you would operate the fund. In order for you to raise money, the rules that you'd have to comply to raise the money would fall under the Securities Act of 1933, specifically Rules 506B and 506C. And that's overseen by the SEC's Division of Investment Management. So 506B lets you raise unlimited capital privately through people you already know, friends and families, but no public advertising. 506C lets you public advertise your fund online or in the media, but you have to verify that every investor that you take is an accredited investor, so no retail customers. So all those three statutes fit together like pieces of a puzzle, and they all work together, and you have to comply with all of them. So let's go through the steps. One, you got to start with SMAs and develop your performance track record, right? You prove your edge using separately managed accounts. You got a clean, verified track record that institutional high net worth investors can audit. Uh, then you would hire securities counsel if you did well enough and you want to start a fund. So don't try to draft the private placement memorandum or limited partnership agreement yourself. They're very, very specialized, and they're not something that you can do with QuickBooks or LegalZoom or an LLM. They're very specialized, and they're unique to your circumstances, and they deal with disclosures about risks and things like that. So if you prepare a private placement memorandum wrong and you get sued, you're going to be in a bad place. So you need specialized legal counsel to map out your 3C1 or 3C7 structure along with your 506B and 506C marketing strategy. And if you're doing derivatives of any kind, like futures or options, then you would also need to comply with the CFTC's Part 4 requirements. Then you're going to build your ecosystem. So you're going to need a prime broker for trade execution and a fund administrator for things like your NAV calculations. And you need a qualified auditor because you have to provide audited financials to your investors. So that's the basics of it. And whether you begin by managing outside capital through separately managed accounts, or if you jump straight into a structured private fund, launching an asset management business is about airtight compliance, disciplined edge, and fiduciary execution. So if you're an independent investor and you're wanting to scale up, drop a comment with your questions on SMAs or fund exceptions, and hit that subscribe button, and you'll see future videos like this. And if you want to work with me either on a consulting or legal basis, you can get in touch with me through the contact info on this site or through my website, turnkeyfamilyoffice.com. Have a great day, everyone.